issue for the population we found. This was a picture taken, it was in The Guardian just a couple of weeks ago. It's a really quite arresting image, I think. This is in Greenland, just a month ago. And this is essentially on the ice shelf. And every year you do see a level of ice melt, but this is the water melted on top of the ice shelf. The ice is 1.5 meters thick, but there's a few inches melted on the top. It does happen, but it's happened much earlier than in previous years this year. And so you have this arresting image. And it's linked to this chart here, which is a picture of Greenland ice melt, the normal distribution over years. And you can see how that distribution has become enhanced and has become, the amount of ice melt that we're experiencing has become greater. And then in this year, it has just shot to a level that is really extreme in the context of previous years. And it shows really quite neatly quite how dramatic the picture is at this stage. And what does that mean for the investing world that we work in? And that's why that background really is why we face what we describe today as what's called, why we are in the process of this sixth industrial revolution, as described by this economist at London School of Economics, Carlota Perez, who describes waves of economic change sweeping through global society and the global economy, which changes the nature of various industries. We're students of Joseph Schumpeter, the great Harvard economist of the early 20th century, who described this wave of change, creative destruction, as being the essential feature of the capitalist system. That industries are constantly being reinvented and changed as we see new technologies, new systems sweep through, undermine existing and traditional industries as new industries spring up. And this is the context in which we invest, and it creates both winners and it creates losers as well across the industrial complex. And it's in that context that we're investing, and that context that we look to both protect investors' capital from industries that are under threat from this transition, and enhance capital from positioning in industries and technologies and companies which are both enabling and benefiting this transition to a lower carbon and more sustainable economy. And that's why we focus exclusively on investing in companies that are enabling that transition and benefiting from that transition as our starting point, as opposed to our starting point being what we screen out and what we don't want to avoid, what we don't want to invest in. And so we see companies that are actively solving sustainability challenges through the products and services that they sell, their source of revenue, as being companies and services that are operating in fundamentally advantaged growth markets. And that's how we set our starting point for the companies that we want to invest in. And we see, so they are both, a crucial dynamic on this is that it leads us to both environmental areas and also social areas as well. So we have health, education, well-being and education as themes in our portfolio, alongside cleaner energy, resource efficiency, environmental services, water, and sustainable transport. Those are the areas that we want to invest in, because every time those companies that we invest in sell more of their product, in lockstep with that, we see better environmental or social outcomes, and that drives growth. And so we can position our portfolio in the context of the overall market in reference to what we think of as externalities. And just to explain this slide a little bit, this is thinking about economic activity in three categories, if you like. On the left-hand side of the slide, we see products and services that every time those products and services are used, they cause harm. They harm the environment or they harm society. And in a way, you can position a lot of traditional ethical screens in that kind of bucket. There are products and services that are actively causing harm. And if we are to transition to a more sustainable economy, then those businesses face something of an existential threat. We talk about stranded assets in the fossil fuel industry, because if we are to achieve anything like net zero carbon by mid-century, then many of those businesses need to cease to exist. And we experience stranded assets on the balance sheets of many of those industries. Tobacco companies, when they sell more of their product, they're harming society. If you internalize the external cost on society their product has through the cost of their product on the healthcare system, those industries would not be profitable. But we will still need, in a more sustainable world, we will still need transportation, we will still need computing, food, clothing, financial services, and we'll still need technology. But it'll need to be sourced and manufactured and delivered in a very different way, and that represents transition risk. Because often overconsumption is a core part of the sustainability challenge. So although Unilever or Marks & Spencer are rated as very good companies from an ESG perspective, and they're very sustainably run companies, they put a lot of attention onto how they run their operations from an environmental footprint perspective, and they work well with their staff and the like. There's a core problem that we overconsume. And by buying more ice cream or shampoo from Unilever, we're not creating a more sustainable world. So we want to invest in companies that every time they sell more of their product, there's an active contribution in lockstep to better outcomes. And that's what we mean by companies on the right-hand side of that spectrum. So we're interested in those companies where the growth is sustainable. Companies like IPG Photonics, which make radically lower energy use fiber lasers used in manufacturing and displacing a product, a technology that uses an enormous amount of energy. So we're leading, by selling more of their product, it's leading to lower energy use. Or TPI Composites, which makes wind turbine blades. And so that leads us to growth, and it leads us to an investment philosophy where the positive impact or the sustainability profile is in lockstep with better growth and better financial outcomes. So we absolutely reject this idea that we're constraining ourselves. Instead, we're focusing on the areas where we see opportunity. And so there should be a symbiotic, a positive reinforcing relationship between more impact or more sustainability and better financial returns in the long run. And that's the core to our investment philosophy. It leads us to markets. Our investable universe of companies that meet that definition is growing substantially at a premium, the underlying revenue growth at a substantial premium to that of both the overall economy and significantly so to some of those industries that sat on the left-hand side of that externality chart, which are actually going backwards. And so this is at the core, really, the starting point of how we think about positioning an investment portfolio. Our ESG analysis on that universe then leads us to quality, and that's core to refining the portfolio. But with a 15-year track record, and just the health warning on this slide here is that this is a composite track record. WHEB, the strategy has been at WHEB for 7.5 years, but it was originally conceived at another place, at a large multi-asset investment house. And so this is a knitted together track record of the whole history of the strategy, which dates back nearly 14 years now. But you can see it against the MSCI World Index, creating value or outperforming over that longer period of time. And that's what we're looking to continue to drive. Now, I think it leads to another issue, though. So we are, the first and foremost, we are an investment strategy. We are here to protect our investors' capital and to deliver superior investment returns. But I think the notion of focusing on positive impact has another very crucial aspect for the financial services industry and for an investment product, particularly in how it relates to their customer base. Because I think the whole industry has a real problem. And that is that the underlying investor, whether they are a saver, a pension fund beneficiary, or a high net worth individual in a family office, the underlying beneficiary of an investment, the asset owner, is disengaged from the product that the financial services industry is presenting to them. They find it boring because it is a series of numbers, algorithms. It's a black box, and it's very difficult unless you are in the financial services industry, unless you are a financial services professional, to understand what is happening inside that black box. And for that reason, it's very difficult to build a trusted relationship, an engaged relationship with an investment strategy. And that is because it's become financialized. It's become money being about money for money's sake, and money and in a very mathematical formula kind of way. It seems to have become unrelated to the underlying activity in the world that we live and the basis of money being invested and put to work to create products, to create services, to build factories or build useful products used in the world around us. And that is why the basis of impact investing and impact reporting can fundamentally change the way that we think about this. And this is a cutout that we used at our conference, where we used a notional investor called Teresa, who's on the brink of retirement, who might be thinking about investing in a fund and how she might think about it. But if we're teed up, I hope we're teed up to jump out of the presentation and onto the website, and I can show you this in a slightly more live way. Is that okay at the back? Can we jump off? Here we go. So this is moving on to WHEB's website. And if we can just navigate across the top to where it says Impact and click on that there. We go to our Impact microsite. And down the left-hand side, if you click on where it says Impact Calculator, this is a dynamic calculator that allows any investor to input into the field there where it currently says £0. You can input any amount you like. So we'll take just a notional investment. Let's put £50,000 in to the calculator there. And then you can scroll down on the calculator, and that allows you to take the amount invested and what that money has been working towards achieving. So over a year, £50,000 has been working towards achieving 90 megawatt hours of renewable energy, avoiding 40 tons of carbon emissions, working towards distributing and treating wastewater and tap water for consumption, diverting waste from landfill, people receiving treatment in the healthcare system, and providing tertiary education. We can actually create at the very bottom, we can create a statement for an investor. But you think about that, how that changes the relationship somebody can have with their investment. So rather than looking annually at the investment return that an investment has had in isolation, so your investment of £50,000 has made a return of X, it was worth X, it's now worth Y, end of conversation, because it's just been run through the black box and the simulator, and it's come out, and that's what's been spat out at the end. Actually, what we're talking about is that £50,000 has been taken, it's been put to work in the real economy to create useful outcomes for society and the environment, and that's and useful value, environmental and social value, and that's the basis on which an equitable investment return has then been returned to the ultimate investor. And that changes that conversation quite fundamentally. So thank you. I hope that's a useful introduction.
Well, you can all log on to the website and see how much you want to invest and how much difference you can make. But George is absolutely correct that this allows ordinary investors to engage with what's going on in the background instead of big theoretical discussions which we have at university and so on. Yeah? Thank you very much, all four of you, for those interesting and excellent presentations. Clearly, there needs to be quite a bit of cross-fertilization between the four of you in terms of seeing how we can benefit from these interesting areas. If I may ask small questions to each one of you, and then we can open it to the audience. So, Salman, you said that from your understanding and analysis, there seems to be enough supply of sukuks for at least the Takaful companies to meet. My question is this supply of sukuks sufficiently liquid to allow them to use it as a proper asset class?
You're right. A lot of the sukuks that are issued are not highly liquid, not rated, but there's enough liquid sukuk. So a lot of the sovereign countries, the central banks are issuing sukuk. So Saudi Arabia, Qatar, Bahrain, Kuwait, Malaysia, their central banks are issuing, and those are highly liquid, highly rated, and there's enough of those for Takaful companies to invest in.
Okay, that's interesting, because I always hear from Takaful companies that yes, there are sukuks, but they are not liquid, bid-offer spreads are too high, and so we don't want to enter into there. We rather stay in real estate.
It's a bit surprising, because we hear the same thing, that they're like, oh, there's not enough depth in the market, there's not enough liquidity, but they're happy to invest in real estate, which is even more illiquid. So there's a disconnect between what their stated aims of liquidity are and what they're actually doing.
The other worry I have about real estate, as you showed quite a significant involvement in real estate, is that even investment in equities in those countries, especially GCC countries, is mostly fronting real estate. Yeah. So really compounding your real estate concentration. Is that my correct understanding?
Yeah, I think there's a significant contagion risk of real estate going bad because you are exposed to it via physical investments, investment properties, and then your equity investments are predominantly in real estate companies. So if the real estate sector goes bad, you're going to get a double, triple hit. And yeah, you're right. There's a huge correlation.
Okay, good. Now for Maaqil. Maaqil, if we want to do this kind of simulations, right? Is it very difficult or is it quite straightforward?
It's quite straightforward, actually. I mean, we have the underlying data for our Shariah indices, and we own all the underlying data for our FTSE for Good ESG indices as well. So to look at the similarities and the overlapping constituents between those two indices is a very easy thing to do.
So for argument's sake, if we wanted to encourage the creation of an index, which is a composite of the two, that is in theory quite possible, right?
Yeah, absolutely, yeah.
Because then we can force people like Shiraaz to track that index.
That's right.
And better than, yes.
Exactly.
So, coming to Shiraaz. Shiraaz, how would you go about incorporating some of the ESG considerations into this?
Yeah, so it's not explicitly part of our process, but it happens throughout the process because for us, high quality is obviously got that angle of sustainability. So a constant question we ask ourselves is that company going to be around in 10 years, and how do I value it? So something like, it was interesting from George's presentation, a lot of those companies there are companies we end up owning because of that question. The high quality fund has no exposure to oil and gas for that very reason. We don't know if it's going to be around, and then we don't know how to value it. So for us, it's tying that question in, will it be around? Can we value it? And therefore, our portfolio actually screens very well. We use a third-party provider called Sustainalytics for ESG criteria. So it's an informal process, I would say.
Now, in your experience, now you are obviously looking very seriously at Sharia constituents in your fund. Have you found constituents which pass the Sharia test but fail the ESG test?
So thus far, in terms of the one we've built, I would say no. There's lots of overlap in that space.
Okay, because what Maaqil showed is that if you take out the common constituents between the two, is it about 400, you said, Maaqil? So 1,400 in the Sharia, 1,000 in the FTSE for Good, and then only 400 meet both.
So remember, our watch list is then smaller than that.
Okay.
So within our watch list, we tend to stay towards companies which have high ESG criteria just because of the way we look at the world.
Because I always want to get Sharia investors thinking that just Sharia is not enough. If you want to go to ESG, you want to actually go a bit further and make sure that they are both. The next question for you is that in your process, do you naturally find that highly leveraged companies are screened out because of other reasons, not because of debt criteria?
Sorry, what?
They're normally screened out just as a process.
Yeah. So that is one of our quantitative screens again. So by the time we get down to our watch list of 120 companies that we constantly monitor, those companies tend to be gone already.
Yeah. So coming to George, we've been talking for the last couple of years now. And as I said, we have a lot of interest in this space. Although you don't have a specific gearing criteria or debt criteria, do you also find that in your process you normally screen out most of those highly indebted companies, whatever their activity?
Yes, this is working. Yes, a little bit like was described just a moment ago. We're looking for. We look at when we talk about sustainability, we talk about what and then how. And a lot of what I was talking about was what companies are selling. So what markets are companies operating in? Is that a sustainable market? Is that a product that has a sustainable outcome? The core, though, of how we then pick stocks from our available universe is about looking for quality. We want to find high-quality opportunities from that growth opportunity set. And our approach to quality is fundamental. And it is very integrated from a perspective of ESG. And really, the way I describe it is that ESG and quality reside in the same place. If you're finding companies that have a good perspective, a well-managed, have a good franchise and look after that franchise and protect it well, and have a sort of good approach to that, then you generally find financial aspects of quality at the same place. We're interested in both. And clearly, a critical aspect of financial quality is balance sheet quality and balance sheet leverage. And so we're interested in businesses that have strong and robust balance sheets, and that means that our portfolio tends to have lower leverage sort of structurally as a result.
So if hypothetically we were to overlay a Sharia screen on your portfolio, I would expect quite a high coincidence there, yes?
So yes, I mean, in terms of the sort of portfolio activities, in terms of the companies and the markets that we invest in, then we tend to find that that's very consistent. And then the other aspect of balance sheet leverage, then we are oriented and culturally sort of focused in the same sort of direction.
Now, the other question I have is that if you get a huge wave of investment into this space, will you be overwhelmed, or you can still deliver the returns which you have?
So I think it's a critical question for all fund managers, really, regardless of where they operate, is how they manage capacity and liquidity in a disciplined way. And obviously, with everything that's happening in the UK market at the moment, particularly with a certain eponymous fund manager, this is a very pertinent question. We have always set ourselves, we are a mid-cap oriented strategy. So to focus on the markets that we do, we focus on mid-sized companies. Okay. We don't focus on small companies. We are companies that are established with established markets and market position, etc. We have set at an early stage the capacity in our product as $3 billion. Today, we're about to go to 500 million sterling, so $700 million or so.